Very important, and this is the key of this chapter, is that using the DOM doesn't automatically give you an edge. And I want to repeat that 3 times or 300 times. Using the DOM doesn't automatically give you an edge. Okay, too many traders will take an education program going, I want to, do the DOM because that's going to make me successful as a trader. Okay, the reality is the DOM is a tool, the same as a footprint is a tool, the same as candlesticks are a tool, the same as the SRM application is a tool. Okay, they are all just tools. They all take data and they show you data. That's what they do. Don't be misguided or misled to think they'll solve your problems. They will not. Okay, you need to know how to use the tool. If you know how to use the tool, how to apply it, and when to apply it, by all means, then you may develop some form of an edge. Okay, but whilst the depth of market can be a very valuable tool for many traders, it's got some extreme drawbacks. Okay, and I'm going to take you through those drawbacks and limitations that you need to be aware of. The first, information overload. Okay, if you've ever watched a DOM, and we'll get onto this in a second, it can display a lot of information simultaneously. It can be very overwhelming for most traders, especially beginners. Okay, managing and interpreting all this data in real time is extremely challenging. Okay, please take it from someone that's done this now for 12 years. Do not be lulled into a false sense of security. There is a lot going on the ladders, and you need to know how to minimize that information overload. You need to know how to look at the right time at the information being provided. That's the real key here. Okay, in a moment, I'm going to show you how we solve that. The next, market noise. When the markets start moving fast, the DOM gets very noisy, and orders can very quickly appear and disappear. This noise can make it very difficult to spot anything meaningful in terms of a pattern or market sentiment. Okay, be very careful. When the ladder starts to move around, you will see something, you'll interpret it, when in actual fact, it could be 100 different things going on. Okay, so there's a lot of market noise on the ladders. The ladders, unfortunately, have also got limited historical data. In other words, what you're seeing in front of you on a price ladder is the right now, right here. It's the supply and demand exchanged at each price. It's the interaction happening now. It doesn't tell you anything about the interaction yesterday. It doesn't tell you where we are trading in terms of value. It doesn't tell you if this is a good or a bad price. It doesn't tell you if you've got a high probability of moving up or down at this point. It's simply just what's going on at this price in real time. Okay, so there's very much limited historical data when it comes to the price ladder. Okay, order spoofing and price manipulation. I think that goes without saying. You should all be well aware of that pretty much everything you see here is rubbish. Okay, none of that's real necessarily. You've got thousands of different algorithms that are pulling and pushing orders. And the reality is, to make any kind of conscious interpretation about these numbers is really just a waste of time. Okay, however, as a little tip, and I'll show you in a moment, what's more important is if someone sells 1,000 lots at this price into this price called 43.18, that's a hell of a lot more important, because that's real, that's actual. Okay, so what we have to do as traders using a DOM is we have to learn to differentiate between what's real and what's being marketed or advertised. Okay, this is what's being advertised. This is what they want me to see. What should I be seeing? Okay, and this is where, if you've known me for a while, this is why I'm a big fan of footprints, because there you can see exactly what's traded as opposed to what's being advertised. Okay, the DOM is not suitable for all strategies. Okay, the DOM is very well suited, yes, for day traders, for scalpers, for short-term traders, and who are ultimately relying on very quick order execution. However, it's not as useful for traders employing longer-term strategies. Okay, it can, if anything, if you're a swing trader or you trade maybe 1 or 2 times a week, I'd say to you, you don't need the DOM. Okay, it's gonna add more noise and complexity to your understanding interpretation than value. Okay, so again, like I said to you, with trailing stops, for some people it's suitable. The same thing with a DOM. Okay, it is suitable to some traders, not all. Okay, ease of access. This is a big problem with regards to the DOM, because it's so easy, and I'll show you this in a minute before, because it's so easy for me to click in and out, all right, gambling becomes a natural tendency. Okay, and most of you who have used a DOM will all put your hand up and say, yep, nope, I agree. It's just too easy to click. I get sucked in, I break my plan, I break my structure. Okay, which leads to the next one, FOMO. Okay, unfortunately, because the market's ladders move, because we get excited about a price, because we see something happening, we get sucked into the Vegas lights. Okay, the next thing we're doing things we don't want to be doing. The next thing we're losing money we shouldn't be losing. Okay, equally, because it's moving around very fast. There's emotion, okay? Because it's moving very quickly, up, down, up, down, up, down. There's stress. Okay, so very important. These are all massive drawbacks to trading the DOM, because if you didn't have the DOM, you wouldn't suffer from FOMO because you wouldn't even see what's going on. You wouldn't have the emotional stress going on. Okay, lack of structure. Okay, this is a very, very big key. When you're trading the DOM, typically what happens, you forget the plan. Right? Why? Because remember what I said to you. When you're trading the DOM, you're seeing what's happening in real time. You're seeing how price is being interacted in real time. What you're not seeing is this a good value trade? Am I trading at support? Is this a support, a key support? You're not seeing any of that because you've got no historical data, okay? All you are seeing is interaction at that price and point in time, okay? One of the key ones, subjective analysis and interpretations. Now, I always laugh because I remember when we were trading, one of the common excuses, because it was an excuse, one of the common excuses we used to use when we got stopped out is we would always go to the teacher or the mentor and we'd say, yeah, no, look, I was long and I got long because of the price action. Okay, we always use that term of phrase. I got long because of the price action. Okay, that's the biggest load of rubbish. The reality is that the ladder, or the price ladder in general, there are a few interpretations that you can make objectively, and I'll talk about those in a minute, things like iceberg orders. Okay, so there are a few very objective interpretations that you can make, and you can develop strategies from them. But pretty much 99% of everything you see on the price ladder is subjective. Okay, and the problem with that, as you know by now, if you're developing subjective strategies, you're going to ultimately have very poor outcomes in terms of your trading. Okay, the reality is the more objective you are in your analysis, the more you'll be able to find repeatable patterns. Okay, so that's the big drawback with the price ladder, is it's very much pure subjective analysis. Okay, and then finally, access to highly volatile scenarios. In other words, when you've got the DOM, when things move around, when it's FOMC, when it's Fed meeting, when it's NFP, when it's oil inventory data, guess what? You've got access to some of the most volatile scenarios in the market. What that also means is you've got access to losing a significant amount of money very quickly. Okay, so it's a drawback. Yes, there are obviously very big benefits to the ladder, but you've always got to assess things in terms of these are the pros, these are the cons. Does it make sense for me? Right, and this is the key. When you go online now and you go type in, I want to take a DOM education course, the first thing you need to determine is it applicable to you? Is it going to add value, or is it ultimately going to withdraw value? That's the important thing to determine before adopting the DOM as a tool. Okay, now, the mistake I see so many traders make. Okay, like I said, they want the DOM because they presume it gives an edge. Okay, yes, if you know how to use it and you can apply it correctly, it will give you edge. Otherwise, it's going to do nothing but cause problems for you. Now, let me show you some of the benefits of the DOM. And then what we're going to do is we're going to move on to a practical example. So order placement. Okay, and I'll show you this all in a minute when I get onto the DOM, but you can enter whatever price you want. Okay, you can get the exact price you want, and that's significant. Right. Equally, I got speed of execution. I can enter at the exact price I want. I can order very quick. I can enter very quickly. I can place orders all over the show. I can enter multiple markets all at once. I can use the price correlations. There's a lot of benefits to having 6 or 7 markets all side by side and seeing them moving up and down. Okay, so that's the major benefit, is that I can get in and out very, very quickly. Okay, and I also obviously get perfect price entry. In other words, if I want price 22, then I get price 22 ultimately. I get the price I want. Okay, that's very different to traditional trading where you would cross a spread. Nowadays, you get the exact market price you want. Okay, stop management. Very, very crucial, right? You can put the stop exactly where you want it, and you can be very specific with stop management, okay? In terms of change in price dynamic, you can see what price is doing. In other words, you get a feeling for what price is doing, for how it's moving, for how it's changing, okay? And this is something that you intuitively learn when it comes to trading, okay? You can see price interaction. So you can see if price is moving slowly or is it moving fast? Is there high volume? Is there low volume? Okay, you're picking up on all of this in real time. That gives you an advantage over slower moving things like candlestick charts, like the footprint chart. Okay, you seeing things in real time, whereas a candlestick chart is kind of building the picture in a much slower time frame. Okay, you can also assess liquidity and volatility. Okay, so you don't have to wait for a candlestick to show you it was a volatile day. You can see it in the way price is trading. Okay, you can also see how much liquidity is in the order book. All right, and then also we have scalping opportunities. Okay, so in a minute I'll show you different types of scalping opportunities, but the main three, and these are the objective strategies you can develop. One is flipping. Okay, so where you do have a flipper in the market or someone that's building out a position. We've got iceberg orders. Okay, so very, very big orders that are transacting over a number of prices. And then large orders at the open, okay, or an open drive effectively. So these are three trade strategies that you can develop using just the DOM, okay? But you trade only these three trade strategies using the DOM. You don't go and invent stuff using all that subjective information that I was talking about earlier. Okay, we've also then got order entry types, and this is very, very important for particular day traders. There's a number of different ways you can enter the market, and again, in a minute, I'm going to show you different types of order types and where you're going to use them. Okay, so very, very important. With the DOM, we do have different order types, and then access to volatile events. Okay, the same way access to volatile events can be a drawback, it can also be a massive upside benefit. Why? Because it means we can get in early when there's something significant in the market, and we can ride the wave as those big fund managers, big institutions have to step in and execute. Okay, so there is a benefit as well to having direct market access. Okay, that's the advantages. Now, enough talk. Let's do some practical stuff. Okay, so what I'm going to do is I'm just going to get this up, and I'm just going to get this up next to it. Okay. So what you've got in front of you on the left-hand side is you've got the Tradelo application, and on the right-hand side, you've got a DOM. Okay, this is one of the DOMs that can be utilized within the trading application. If you've got a Rhythmic connection and you trade using the back-end Rhythmic data, you can obviously connect your application up to the Tradelo application as well. Okay, so first things first. What I want to talk about is some of the, like I was saying, some of the benefits of ultimately being able to execute on a DOM. So we're going to start off on the right-hand side. Yeah, I've got the S&P 500. On the left-hand side, I've got the gold market. Okay, so very quickly, I can just simply in and out. Okay, so I can literally in and out, in and out, in and out. Nice and quick. There I'm executing live in the market. Okay, now why does that matter? Well, if something comes out now all of a sudden and the markets start to go a little bit crazy, I can just double click, bang, I'm in, double click, I'm out the market, nice and quick, nice and fast. Don't have to overthink things, okay? And if I want to get my risk out, I can simply drag, and I'm out of the market. Okay, so speed is very, very important for us as day traders, nice and fast, in and out, okay? Now, the next thing for us is in terms of limit orders and stop limit orders. So I was talking a lot about the order types. Okay, we've got a number of different order types, and they matter. And I see far too few traders knowing how to and when to deploy different order types. Okay, let's start with a very basic. When should I use a limit order versus when should I use a market order? Okay, well, the reality is when the markets are moving very aggressively, they're very volatile, and the market participants are not price sensitive. In other words, no one cares. They're not going to let the market come back. At that point, I'm going to the market. Okay, I don't want to wait. I need to execute at market because there's no price sensitivity in the market. Okay. Now, when the markets are moving two-way and there's a lot of two-way trade going on, sure, then let's use a limit order. Okay, let's not hang around. We can use limit orders. We can afford to let the market come to us, and we can be a little bit more passive. Okay, for now, just ignore this little thing going on here. It's just a guardrail talking to me. I'll talk more about that in a minute. Okay, now, what's the difference between a stop loss and a stop market order? Well, let's say I wanted to ultimately play a breakout here at 48.50. Okay, a stop limit order says I will only take price 48.5, whereas a stop market order says I will take any price above 48.50. Now, why does that matter? Well, when markets become highly illiquid, okay, the reality is if you're using stop limit orders, you run the risk of never getting a fill. In other words, we call it market skipping. Now, most traders will learn this the hard way. I've learned it the hard way, as have most traders I know. The reality is when you're using stop limit orders, you have to be careful, because if someone came in now and they bought 1,000 lots, it will skip over me, it won't fill me, and it'll trade above me, even though I've got a stop limit order. Whereas if I use a stop market order, what it'll do is it will add me to that 1,000 lot order. So it'll be 1,000 lots plus 5. The 1,000 lot gets filled first, then I get filled. Okay, so yes, the risk to a stop market order is I get a worse price than I want, But the upside is I'm guaranteed to get a fill. Whereas a stop loss order or a limit order, ultimately I can only get that price and no other price. Okay, so very, very important to know the difference and make sure you apply it correctly. Okay, some other order types. Bracket orders, very, very good order types. What are these used for? Well, if you're trading fast markets, if you're trading sort of, a liquidity event where you're looking for a bit of an unwind of positions, okay, something like a bracket order is very nice. Why? Because what happens is the moment I enter the market, let's fill this, okay, the moment I enter the market, what's going to happen is you can straight away see the market puts my stop in place and it puts my target in place. Okay, so I've got a target and a stop in place immediately. I don't have to actually go put another stop in. Okay, so a very, very clever order type, but use it in the right scenarios, i.e. when you have nice volatile events and you're looking for a position unwind type strategy. Okay, let's exit that trade. The other type of order type that's very, very nice and handy to use, and I suggest most traders use, is what we call an OCO. In other words, one cancels the other. Now, all this says is that if I have a trade in the market, let's quickly just do a limit order here. Okay, so let's say I'm short the market and I want to now go and put in a stop and a target. And effectively, what I don't want to do is forget about my stop or my target. What I can do is an OCO. And what that means is when I put the stop in, okay, if I go put the stop in, what it says is if whichever one of these gets hit first, the other one gets pulled away. Okay, so OCOs are very, very nice, particularly if you're someone that doesn't trade, or doesn't watch the markets 24 hours a day. You just want to make sure that when your stop gets hit, the offer or your target gets pulled as well. And equally, if your target gets pulled, your stop gets pulled away. Okay, so OCOs are very, very handy order types you can use as a trader. Okay, so there's just some of the order types to be aware of. And that you can start deploying immediately as a trader to develop edge. Okay, now stop management. This is very, very key when it comes to using the price ladders. Like I said to you, okay, if I'm in a trade, if this is a fast moving market, okay, I can instantly go and say, well, I want my stop at 44 3/4. I don't want it at 44.5. I don't want it at 45. I want it at 44 3/4 because that's where my trade's invalid. Okay, now for most of you that trade smaller accounts, okay, whether it gets triggered at 45 or 44.5 or maybe a little lower, maybe doesn't make a big difference, okay? But if I was to use a 50 lot, every single price increment, okay, is going to make a $600 difference, okay? So a one price difference is $600, okay? So price matters, or at least, exact precision as to what price I'm being filled and executed at really does matter when it comes to trading larger position sizes. And that's why the DOM is very, very important and handy for professional traders, okay? Then, like I said, as we're watching price here, okay, we can see just by observing how much volume is trading here, we can see what the interaction is happening between buyers and sellers, okay? So we can see some 100 lots are coming in, some 100 lots are being advertised on the bid, but the reality is, like I said to you, professional traders are focusing more on this thing on the right here, which is the actual transacted volume, okay? How much volume is being transacted at each price? And you saw that 45 1/4, a little bit of a reload, and the market went bid up. Okay, so we can see someone's reloading 45 1/4, which means someone should lift the 45.5 straight after that. Okay, so the reality is we're watching actual volume being traded, and that's again why we use the price ladder. Okay, we can also see the interaction. So we can see how the buyers and sellers are interacting with each other. Are they moving slowly? Are they moving quickly? So right now, without even looking where price is trading, we can see that there's a lot of two-way trade going on and a lot of low volume trade going on in the S&P 500. Okay, so very, very important is we can see the different price interaction. Like I said, we can also see volatility and liquidity. Okay, right now the markets are a little bit more volatile, but they're still quite liquid. Okay, so we can see there's still 100 lots trading. If you go and see the S&P over a volatile event, or perhaps, when the VIX is above 25-30, you'll only see 10 and 20 lots on the bid versus what we see now, which is 100 lots, 200 lots, etc., etc. Okay, and then lastly, the different types of order strategy. So to show you a flipper now and show you iceberg and large orders at the open, that's not going to be possible. What I can show you is you've got some 200 lots, yeah? Okay, so in a basic sense, what a flipper is it's ultimately where a market is creating or advertising very high supply or demand on one side of the market. Okay, so if, for example, we suddenly saw a 300 lot come in at 42 quarters and it pushed the market back down, we could simply then take the other side of the trade because that order being advertised is in actual fact false. Okay, now, yes, your question is probably going to be, is that allowed? Is that legal? In a simple sense, the CME's rules on flipping is ultimately that at the end of the day, so long as you are transacting a strategy and not manipulating the direction of price, then in essence, it's fair play. Okay. However, again, there are some very sort of red line approaches that are used. We're not going to go into that now. But the reality is that, yes, flipping does happen, and it's a very interesting strategy to take advantage of if you know how to use it. Okay, so there are different strategies you can deploy just using the price ladder. But again, you need to know how to deploy them. You need to develop an approach for them. You need to develop an understanding as to how you can be profitable with them so you can find some form of an edge. Okay. Now, what I want to show you is I actually just want to introduce here the Tradelo application briefly, just so I can show you how a lot of the weaknesses. So we spoke about the weaknesses of the price ladder, in terms of noise and complexity and all these sorts of things going on. We spoke about how those weaknesses you need to be aware of them as a trader. And what I want to show you is ultimately how the Tradelo application solves for a lot of those problems. Okay, the first being structure. Okay, now what I'm going to do is I'm going to take you through the basic, baseline of adding a trade onto the risk manager. And it's as simple as the first thing I ever do when adding a trade is I simply tell the risk manager stop. Okay, this is one of the key sort of proponents of the Tradelo application. We put risk first. Why? Well, because if you take care of risk first, it means you're putting things in the right order, or you're prioritizing risk, which is exactly how it should be. Okay, once we've done that, from a trading perspective, everything's done. Okay, because yes, sure, we're still going to struggle, when this starts to move with a bit of FOMO. There's still going to be a lot of noise. There's still going to be a lot of information overload. However, if I'm trading an open drive in the E-mini S&P 500 and it's sitting right there in front of my face, and that is my plan, that's what I plan to do today. The reality is that it's a lot harder to break your plan. It's a lot harder to go against what you wanted to do. Okay. Moreover, if I was to, for example, go and do a breakout trade in the gold, okay, and I added this, the moment I go do that breakout in the gold market, if I've got a strategy card and the strategy card is ultimately telling me, well, look, you're entering there, you're stopping there, and you're targeting there, the reality is it's a lot harder for me to break my intended plan. Okay, it's a lot harder for me to suddenly go and get stuck into the price action that I'm seeing on the gold market. Okay, because I'm sticking to a plan, I'm following a predetermined recipe for strategy success. Okay, so the application in itself is not going to be solving your problem for you, but the mere fact that it's sitting there in your face, the plan's sitting here on your face, is going to give you that structure you need to avoid the FOMO, to avoid getting sucked in to the noise, and to avoid overcomplicating things. Okay. The next thing, like I said to you, because we're adding trades first, right, and we're thinking about risk first, this slows you down. Okay, now one of the key sort of pieces of feedback we've had from a lot of traders is they're really glad that they're being slowed down, including scalpers. Okay, one of the big arguments I have with a lot of scalping traders is they say to me, well, you know what, I got to trade this gold, so I've got to go, I got to go quick in and out. There we go, in and out. I don't have time to go capture that. Okay, well, the reality is, if you're not capturing your data, how do you know if you have any edge? Okay, moreover, one of the challenges I always say to a scalper is I say to them, tell me what your position sizing's done with your so-called strategy over the last year. And they'll tell me, oh, no, I always just do the same amount, which is a one lot. Okay, the reality is you are never going to be able to leverage a strategy without edge. Okay, so if your objective is to make money as a trader, the reality is you need data. You need objective data to inform your decisions, to inform if you actually have got an edge or not. Okay, so very much the system does slow you down. However, for the scalpers, okay, it's not that a tool doesn't exist, right? There's a scalping tool. Okay, so rather than having to go and click twice, you can simply click once. And the moment you click, your system's going to tell you, well, you want to trade 2 lots, and you can trade your 2 lots. Okay, and everything just updates in real time. You get your strategy cards popping up. And the moment you exit that trade, well, guess what? All of that data is now captured. You've missed out on nothing of that data. If I go again, I'm like, yeah, I want to scalp this market. Bang, I'm in again. Okay, I'm stopping out. Well, guess what? all of that data is again captured. Okay, we never lose any data, and that's really, really important for traders. Okay, the days of not being accountable for your data are long gone. If you're someone that's not capturing your trade data, okay, you are missing out on a key edge. You've got to capture your trading data, because that's ultimately going to inform what works for you and what doesn't work for you. Okay, then you've noticed these funny little things going up on red here that says trading without risk. Okay, earlier on I spoke about risk management, okay, and being consistent with risk management. This is at the heart of the Tradelo application. Okay, it's just guiding you to do the things that are going to be in your long-term benefit, which means I'm not putting this risk on. The system's saying to me, look, Brannigan, go and put the risk on, please. It's for your own benefit. Go put the risk on. Tell the system where your stop is. The system says to me, well, look, you actually should be long 5 lots. You're now under risking. I can go and put that trade on, and I can then fully just leave the trade, put the stop in, and let the trade play out. Okay, so very, very important. The risk system is there to keep you consistent. And this is one of the big weaknesses for many traders, is they're adjusting the approach they take to risk over time. Okay, the Tradelo application takes care of everything for you, not just over time, but also automatically. Okay, if I go and execute in the gold now, you can see the gold market on the left-hand side. It says I must buy 6 lots. If I go and execute in the gold, straight away now I'm running 2 strategies at the same time, but I don't have to think. I don't have to think how many lots should I trade. Okay, I don't have to think what's going on. Everything's updating in real time. I can simply just go and put my stop in the market, okay, and everything's being taken care of for me. Okay, and this matters. Okay, when things get volatile, when things get crazy, this really, really matters, knowing that risk is taken care of beforehand. Okay, volatile events. All right, this works very, very nicely to it. If I've got multiple markets going on, okay, one of the big things I see from a lot of, again, sort of advertisers, gurus, all that sort of thing is, don't trade the FOMC, or don't trade the non-farm payrolls, or, if you're going to trade the non-farm payrolls, you're going to be chicken fodder. That's the kind of sort of noise and rubbish I hear from the social media land. The reality is professional traders trade all these things. Why? Because they're opportunities. Okay. Now, again, remember what I said to you, because risk is taken care of beforehand. If I'm trading non-farm payrolls, okay, I'm going to go into my risk system. I'm going to go and enter my trade strategy called non-farm payrolls. We haven't got it yet, but let's call it a gamble trade for now. And I'm going to go and put in my stop of 40 ticks. In other words, I'm going to risk 40 ticks on the non-farm payrolls because it's more volatile. And notice what my risk manager does straight away. Okay, previously it was telling me you can use 5 lots. Now it says use 1 lot. Okay, in other words, it's adjusting for the fact that non-farm payrolls is going to be volatile. Okay, now where most traders botch these volatile events is that they will use the same size. They'll use the 4 lots. They'll go 10 handles offside instantly. They will panic because they're not used to losing that amount of money. Okay, they're not used to going that far offside that quickly. When in reality, oh, okay, my risk is taken care of. I'm risking the same as if I was entering one of my A plays or one of my B plays. Okay, and that's really key. If you want to learn to trade risk events and you want to get really good at them, okay, the reality is you've got to take care of risk beforehand. Okay, and then lastly, like I said, just to reiterate, all your data has to be captured every time you're making a decision. Okay, whether it's under risking, okay, or whether it's over risking. If I go into the S&P now and I sell 5 lots, okay, the reality is that your system is capturing, it's telling you you're over risking. Okay, now with that data, you can go and look, you can have a deeper insight and look, how are you performing when you're over risking? Okay, are you cutting your trade short? Are you getting out too soon? It's so important that you're capturing all the decision-making data that goes into your trading, because with that data, you can start to make informed decisions. Okay, and again, it's crucial. It's all about consistency. Okay, I see a lot of traders, they've got journals, and I think journals are fantastic. I think they're so important, and they'll journal for 1 or 2 weeks. And then it gets hard, and then it becomes a difficult chore, and then they stop journaling, and then they stop seeing the benefits of it. Okay, with all of these things, you've got to do it consistently for a period of time, and then you start to see the results.